Welcome to this week's edition of Echo45 Advisors Market and Economic Update. In this video, we'll discuss why investors have much to be grateful for as we head into the holiday season. The holidays are a perfect time to pause and reflect on what went well over the past year. In this case, there's a lot to be thankful for. Despite concerns over tariffs, valuations, and political uncertainty, financial markets have delivered strong results this year. The S&P 500 has generated double-digit returns so far this year, while bonds have returned approximately 7% so far. International stocks have even outperformed the U.S. for the first time in many years. Many diversified portfolios have benefited from this broad-based performance. So, what should investors keep in mind as they prepare for the coming year? First, we've now entered the fourth year of the current bull market. This bull market cycle began after the market bottom in October of 2022. It has continued despite many fears of recession and bear markets along the way. History shows that bull markets typically last much longer than bear markets, often running for 5 to 10 years or more. While past performance doesn't guarantee future results, this shows that market concerns don't always derail the market cycle. The bond market's positive returns are also important to highlight. After the challenging interest rate and inflation environment of recent years, bonds have recovered as rates stabilized. This resilience underscores an important principle. Trying to time markets around short-term events is not only difficult, but often counterproductive. This was especially true in April when markets fell sharply as new tariffs were announced. Markets not only rebounded quickly, but rose to new all-time highs. Investors who remained disciplined were rewarded. Second, inflation has improved, but the Fed is cutting rates. Inflation has come down significantly, even if progress has been slower than many would prefer. Prices have risen about 3% over the past year. While this continues to be a challenge for households, from an investment standpoint, inflation has been much more stable. This has allowed the Fed to begin cutting interest rates after keeping them at restrictive levels for most of the last year. Historically, low rates benefit both stocks and bonds by reducing borrowing costs and making existing bonds with higher interest rates more valuable. So while inflation and interest rates remain important factors, fears of ever-rising inflation and interest rates appear to be behind us. Finally, proper asset allocation continues to help manage risk while capturing opportunities. The year ahead will likely bring new sources of uncertainty, just as every year does. Rather than reacting to every market event, long-term investors can hold an appropriate portfolio that can navigate different phases of the market cycle. This is especially important today because stock market valuations are well above average after a 3-year rally. The S&P 500 price-to-earnings ratio is steadily approaching its peak .com levels. Valuations don't predict what markets will do in the near term, but it makes it important to have realistic expectations and to hold different parts of the market with more attractive valuations. Questions about artificial intelligence will persist, as will political volatility around tariffs, geopolitical concerns, and the national debt. Recent history shows that overreacting to these events can be counterproductive and may derail financial plans. We hope you found these insights helpful. If you would like to learn more about any of these topics or review your specific portfolio allocations, please don't hesitate to reach out. We look forward to speaking with you.